In this episode, we're talking with Alec Renehan and Bryce Leske from Equity Mates Media, and we're going to explore shifting attitudes towards property ownership amongst younger people. And as the wealth divide widens between those who are able to get financial assistance from their parents and grandparents and those who can't, are younger generations ditching the great Australian dream and investing more in shares rather than property? Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
Our guests today are Alec Renehan and Bryce Leske, co-founders, Equity Mates Media, and co-hosts of the Equity Mates podcast. Equity Mates Media is a dominant finance and investing brand for young Australians. It was created to give everyday people the information, confidence, and inspiration to start their own investing journeys. And the co-founders who we have with us today met at university and both developed a passion for investing. And as they spoke to their friends and family about their interests, they realised a lot of people face the same challenges because financial markets are seen as complex and inaccessible, and financial media caters to the industry, but not everyday Australians. So they set out to record their journey of learning to invest in the hope that others would join them. Equity Mates Investing Podcast was started in 2017. In the years since, they've grown a community of young investors, and a year later, at the same time we started our podcast, this one, a second podcast, Get Started Investing, was started as a complement. And so much has changed over those 6 or 7 years. I know from our point of view it has. I imagine for you it has too. We're really keen to cherry pick the lessons that they've learnt along the way. Welcome, Alex and Bryce. Thank you so much for joining us.
Thank you. Love that bio. Yeah. We might need to clip that.
Yeah, a little bit of flashback in time. I mean, it was kind of took my first question away, to be honest, in some sense. I mean, you guys have absolutely smashed it in the podcast space. We're a bit of a dwarf compared to you guys, but why do you think it's been so successful? I mean, obviously there's a gap with financial literacy, but why do you think you've been able to get so much more cut through than a lot of the other people have tried?
I certainly think there is a huge element of right time, right place for the Equity Mates story.
Definitely.
We started out in 2017 with no intention to become what we are today, but it was at a time where podcasting in Australia for financial literacy or financial education targeted at beginners by Australians that weren't experts themselves, that didn't really exist. And so when we started doing that type of content, I think a lot of people related to it. And then you couple that with COVID and the rise of the retail investor, and all of a sudden podcasting and I guess the thematic of investing really just took off. And we were fortunate to have been a couple of years into the podcasting journey, and that's what gave us our audience. But I think if you look at what's out there, we have created content that is relatable, but I think the biggest thing is that it's not by people from industry. I think that's really the crux of it. Yeah.
Which, I mean, in a way, I totally get why that's really valuable, because you're speaking in, the common man's language or the common person's language, right? But at the same time, particularly with finance, it's quite dangerous, right? Because, you could be sharing your experiences and all the rest of it, but if you don't actually have the relevant qualifications or experience and thereby being in the industry, you could be in danger of I guess, letting people down garden paths. So how have you addressed that? Has there been any challenges in terms of the regulators trying to sort of contain your conversations? And is that something you even thought about when you started?
I mean, look, I have a problem with the premise of the question, and I know it's not just it's like it is just such a trope in the finance industry that retail investors are dumb money, and they don't know what they're doing, and the market is dangerous if people are given their own access and their own information and make their own decisions. the people that we call dumb money, well, not that we call, but the people that the industry think of as dumb money are people that they trust to educate their kids or perform surgeries on them, or litigate their legal cases. Like, these are incredibly smart people in other parts of their life who, when it comes to finance, instantly regulators and financial professionals say they can't make decisions for themselves. They can't understand this, which is just a fundamental misunderstanding of who retail investors are. And the data backs that up. I think Gemma Dale from NAB Trade is probably out in front in this, and she's obviously got a wealth of data at NAB Trade. But retail investors make sensible, long-term investing decisions over and over again. Like, for every person that hunted on GameStop, there's 100,000 people that are buying ETFs, dollar cost averaging, and being really sensible when it comes to investing. So I think for us, one thing that we really try and get across when we speak to the finance industry is that everyday investors are just completely underestimated when it comes to what they can understand and what they can do themselves. And it's just that the industry and regulators for so long haven't catered to them and haven't empowered them. And that's something that we really want to do. So that's a high horse that we get on, or that I get on. So, the regulators have looked at us. We have our own AFSL, the whole Finfluencer. I don't know what you'd call it, but there was scrutiny on Finfluencers a couple of years ago. But I think overall, where ASIC landed, and where I think most people can sort of see, like, that there is more good than bad when it comes to people trying to share investing education and make it more accessible.
But also riddle me this: how is it that long-term, well-diversified, low-cost index fund is seen as a risky investment, yet property is completely unregulated, and any Joe blogs can come out and say, if you go buy in this suburb, you can't lose, and take debt up to your eyeballs and all is good. It's just like, come on.
That 95% LVR, just get in there, let's do it.
You won't hear any argument from us on that. Not at all.
Yeah, and I think where Veronica's questions really is that we absolutely see it the same way, right? Your personal accountability, that really determines whether you're dumb money or not. And a lot of dumb money, I would say, have actually gone to advisors thinking they've got this magic sauce. The advisor's heavily conflicted. He's heavily going to try to churn your portfolio and push you to active asset management. And I know there's a whole other tier of advisors. And is that smart money? I don't think so, right? Like, the smart money is actually doing what you're talking about and taking personal accountability. You're educating yourself. Yes, you're still maybe working with an advisor. And, you've highlighted a really good point there around property. I mean, is that some frustration for you when you're in this sort of wealth building world? How do your sort of community feel around the property story and, and their sentiment towards property versus other asset classes?
Well, I mean, it's just the Australian dream and the Australian story is that you build wealth through property. Like, that is, it's inherent in us. And I think only in the last sort of decade where we've seen access to investing in equities, and particularly also getting access to investing in stocks and companies overseas, it hasn't been until those last 10 years that people now see an alternative way to building wealth. But up until that point, like, it was just our parents' stories and their parents' stories were building wealth through property. And that's the goal. It's like, go to uni, get a job, buy a house, all is good. And so I think, we still battle that mentality. And I think now a lot of our community are really battling with it internally as well, for those that find it incredibly difficult, if not impossible, to get access to the stock market, to the property market. It's a real, we have people come to our events and they're saying, I need to convince my parents that building wealth through the stock market is the right thing for me. They're really pushing me, go and buy the property, where it might not just be achievable. So it's like, it's possible to do it now in the stock market. It's never been cheaper. It's never been easier. But that mentality of property is where you build your wealth, that's what we really battle with. And like, our stories are reminiscent of.
Yeah, I mean, we certainly are observing that gap, as I mentioned in the intro there, the wealth gap, as what the Bank of Mum and Dad is now the 5th largest lender in this country.
Crazy, isn't it?
Which is, that's just going to snowball and get bigger. So the gap between those who have the access to that versus those who don't is going to get bigger and bigger, right? And so therefore those who don't have access to that are going to forced to make these decisions. But I guess what you're saying is that socially they're still facing pressure in terms of that expectation, or in terms of that sense of whether we've done well or not, you know, because we sort of attribute that to whether we can get into the property market. But also, and I'm astounded and horrified at this sort of wave of people that still want to buy volumes of property, like volumes of pretty much crap assets, most of them. And, you know, and they're focusing on cash flow as opposed to capital growth, and they're young, you know, and they're missing these huge opportunities to do other things with their money. So in terms of the mindset of your audience, so you're saying that they're wanting to do things differently, but they're facing a challenge in terms of how to get support. Are they going against what their parents are saying? Are they deciding that, you know, or that other wisdom, if you want to call it that, that popular contention in this country, that's the way to build wealth? Are they bucking the system, or are they finding it still that they ultimately really want to still go down that path if they could?
Yeah, look, I don't think it's a choice as much as it is a matter of necessity that, you know, the property market, for so many reasons other than wealth building, is so attractive to people. You know, it's like the sense of psychological security, the you know, not having to rent and be subject to the landlord's whims and all of that stuff. Like
Tax benefits.
Yeah, tax benefits. Yeah, well, I mean, that goes to the wealth building part of it. There's so many reasons why people will want property regardless of the financial conversation. And you can never separate that from the financial conversation, because they're so intertwined in how we think and talk about property in Australia, but really around the world. Like, all of these same factors are playing out with young people in the US. It's just that their property is still far more affordable than it is in Australia here. But I think for a lot of people, they see the stock market as like a means to an end. It's like, I'm going to start building wealth in the stock market because it is accessible, but at some point I want to transition to the Australian dream of buying a house. Yeah. I think what we hope is that through that process, people realize that it doesn't have to be either or, that there are a lot of ways that you can actually supercharge both your property and your stock market journey by using those two assets interchangeably. You know, the classic example that we get a lot of questions about around debt recycling. And, you know, you start building equity in your primary place of residence, then you pull some of that equity out as an investment loan, you invest in the stock market, you get a tax benefit there, and you can sort of build wealth using both. But the challenge is always the start. The challenge is always that the initial accessibility of getting into property. And, you know, there's more and more people talking about things like rent vesting, just because it's a more accessible way to start building equity. But yeah, look, I think property will never not be a goal for people because of all those non-financial reasons. And so it's just about what's the best way for us to get there as young people trying to do it in 2024.
One thing I loved about what you said there, Alec, is that I think that people are in their 20s, right? And they are, you know, say means to end, right? They absolutely are, and they're still leaving money in the bank. They're starting dollar costing into the market, right? And they're educating themselves on shares. And what they really do is getting desensitized to the volatility of shares. And they're getting more understanding that markets go up and down, and that, you know, that you don't have to just buy individual stocks, and you can buy index funds. And, you know, they're seeing the benefits of compounding. And so it's not so much, I don't believe, really around how much money they made versus leaving that money in the bank. I think it's about them brewing the confidence and the behavior in terms of just regularly investing. And what they do potentially, just because of market, they have to basically sell those shares or the equities or the portfolio or whatever it might be, because they need that for the deposit, right? It's just the affordability challenge, right? Let alone, and particularly now with lower borrowing capacities. What it hopefully does is those years of learnings gives them the confidence to get back into the market after they've got into the property, right? And like you say, and when you highlighted already, you know, some of your biggest questions come around that dollar cost averaging, because they want to get back on that wealth building journey outside of property. And the only thing that's going to give them confidence to do that is that early days, is that sort of aligned to how your education's very much targeted around, helping people improve their confidence to invest and actually take that first step away from just putting money in a bank account?
Well, I mean, we created an entire channel called Get Started Investing because we found that there are so many preconceived barriers or misconceptions that people have in their mind when it comes to getting into the stock market. And I think you're right, Chris. We find that as soon as people break some of those barriers, which is, oh, I need a lot of money to start. Well, that's not true. You can get started with a matter of cents. It's like, I don't know what to invest in. Well, there are products available that give you global access in one trade. As soon as they sort of overcome that and with small dollar amounts understand things like volatility, oh, I didn't actually lose all my money. Oh, the market crashed, but it only crashed 5% and then it rebounded 24 hours later. When they tick off a lot of those misconceptions or, that what they perceive as the risks of investing, then we find that they're hooked and away they go. So we do a lot of content that tries to break those myths and misconceptions. We have, countless stories of people saying that I started investing 2 years ago and I'm just frothing it now and the property's out the window the beauty is, as I said, like 5 years ago or 7 years ago when Alec and I started, you needed $500 minimum to get going. And for some people, saving that and putting it all in one lump sum is really daunting. The good news is now you can literally start with cents or small dollar amounts and understand who you are as an investor and how you would respond to markets.
Yeah, the international investing is an interesting one, right? Because a lot of what we've got in our pockets and Drive and, are not Australian companies. And people do like to invest in what they know, right? And what they can feel and touch and see. And I think getting access to international equities has become a lot easier. Have you found that that's also correlated to a lot more interest in investing because people just didn't want to buy CBA and BHP shares?
Yeah, definitely. I think it's hard to separate how much more accessible markets have become, especially the US market, and just how well they have done. You're right. I still remember the Magellan ad. They sponsored a series of the cricket like a decade ago, and it still sticks with me. And it was, someone waking up in the morning and going for a run, putting on Nike shoes, listening to Spotify, just interacting with all these companies that weren't Australian. And so I think everyone is sort of waking up to that. But it's just the just unbelievable performance of US tech. It's like everyone has sat up and taken notice of that. And, even if it was 10 times more difficult to invest overseas, people would probably be still trying to do it just because of how well they've gone. But the good news is now it's just as easy to invest in America as it is in Australia. So that certainly helps.
It's interesting for me too, because I've got my daughter's in year 12. She just turned 18. And she'd been asking me about investing. And of course, when you turn 18, you can get a CommSec account and, or whatever, and you can start trading. And she's not particularly academic. She doesn't really care too much about school, but it's really interesting how she switches on when she sort of gets the idea of, what's happening in the stock market now. And she's been starting to invest and in ETFs and she doesn't even panic when the market falls. You know what I mean? So she's seeing the actual balance go down and she's not panicking. She's actually really, because we talk about this a lot, and she's sort of getting the idea of really what it's all about. And you're buying into companies, and she studies business at school and stuff. And this whole idea about you are buying businesses or buying a little tiny piece of a business. So it's really fascinating. And even just the ease of her being able to do her first trade versus even, I think the first time I did ETS might have been 10 years ago. It was even harder back then, so that you talk about that accessibility. She's not even going into those sense apps and things like that I've heard about. Use your short change to invest. But I think it's really amazing and really fabulous. I love the fact she's taken up on that. But and I think that's really fabulous and amazing that it is accessible for anybody, and so that is really changing things. Do you think though, because still there is a lack of financial literacy in schools and a lack of financial literacy probably at universities as well, I would imagine. Do you think that there is still a huge amount of naivety out there? We talked earlier, the beginning, I said, you guys were beginners, if you like, when you started, if I can say that. you're learning along the way and you're sharing your journey. And I asked about, you didn't have that industry experience or the qualifications or whatever, but there are still people that chase the dream, right? Like, in terms of your audience, how do you, I know in the property space, there's people that make really bad decisions because they're chasing a dream. They don't really want to do the work. Do you think that, what do you think about that? I guess, it is a problem for me. I look at it, I observe it. I observe people in the property space that are basically giving really bad advice and people are following because it's the easy way. Do you find the same thing in your space?
I mean, 100%. Every Friday on our Instagram, we do a wrap-up of some of the worst financial advice we've seen that week. And every week we worry that, is there going to be anything that we can share this week? And every week it seems that there's worse and worse financial advice out there. So there's so much terrible advice, like, get rich quick schemes or people trying to sell like scammy courses or access to Discords and stuff like that. And part of it is, going back to what I was saying earlier, like you have to empower people with the knowledge to figure out what's good advice and what's bad advice and make decisions for themselves, because the way the internet is now, like you can't protect people from every form of bad advice out there. It's similar to, all the scam awareness stuff that we're seeing more and more from the government and the banks. Like you can't remove every scam from people's lives. You have to empower people to figure out what's phishing and what's not and stuff like that.
Right.
And it's the same in the property space. It's like, there's really great people and great advice sharing knowledge, and then there's people that just want to make a quick buck. And it's like, again, we need to educate and empower people to figure out
tell the difference.
The people. And you mentioned financial education there, and for us it's like number one. I look at how Bryce was brought up, where his parents taught him about investing and money from a really early age, started investing in the stock market when you were a kid. And my parents didn't know much about the stock market. They thought, the path to growing wealth in Australia was work hard, save for a deposit, spend most of your working life paying off the mortgage. And that was the Australian dream. And that's sort of how I grew up. And it was only by luck that I met Bryce at uni, and he sort of opened my eyes to this whole world of the stock market. And so for us, it's like, how do you get in front of people that don't learn about it at home or from a mate? Like Dolomites got kicked out of schools and nothing replaced it. It's like we did something really good. We got rid of the bad thing, but we didn't replace it with the good thing. And so it's just like, it's a massive gap that someone needs to step in and help. And we'll do our bit.
Yeah, I mean, Scott Pape's had a good crack, hasn't he, in recent years? But until he gets a bit bored, he probably goes and does something else. He's not going to make a national impact there.
For me, it's like it's opt in versus opt out. Like what we're doing on the podcast, what you're doing on the podcast, what Scott Pape has done with his book and his TV shows. It all requires someone to opt into, I want to learn,
Yep.
I want to understand the stock market, I want to understand the property market. And that is great. And that has helped, between everyone in Australia, there's, thousands, tens of thousands, hundreds of thousands of people that have improved their financial literacy from opting in and learning. But it's, how do you get to those people that don't think it's for them, or they don't have enough money or enough knowledge to get started? Like, how do you get in front of them? And that's where schools are so powerful, and I think that's where we're missing something.
Do you think around have you got too much detail over the last few years around the behavioural finance element to investing? It's something that, early days in advice, I just thought it was all about, the numbers, right? Look at the markets, and everyone's acting rational, right? And everyone isn't, and that's what I just thought investing was, and that's what a lot of the investment houses sort of perpetuate, right? Is that we're smarter than the market. We can outperform it by betting, knowing where the world's going. But as an investor, it's then how you interact with the market. And a lot of that's unconscious. And this is where the premise of this podcast started all the way back in 2018, was us watching the irrational behavior of people entering the market, and kind of what we're talking about now. How have you got in sort of your journeys in understanding that and all the different biases we have as investors, and sort of educating yourself and your audiences on those?
Yeah, I think it's fascinating. And I think it's over the last couple of years, we do more and more content on behavioral economics or behavioral finance, because it's just becoming clearer and clearer how biased we all are in making investment and decisions when it comes to our money. I think for us, I'm a sucker for sometimes doing a bit of a YOLO trade or a FOMO trade, fear of missing out. I think Ren's most famous FOMO trade was taking Bitcoin at its top. But just also other things like loss aversion and, trying to time the market and all of those sort of biases that naturally come that can really ruin your returns over the long term. I dealt with early on in my investing journey, but I think the way that we set up now is to try and get as much of our investing out of our sight, out of mind as quickly as possible. And what I mean by that is we automate all of, like 90% of our investments are automated at a frequency that, every fortnight, every month, the same amount goes into the same investments done by the brokers. And so that takes away the need for me to think about it. It takes away, if the market's crashing, that feeling of, maybe it's not the best time to put it in, or if the market's at all-time highs. Too often we see in our community, the markets are at all-time highs, it's not a good idea to invest in the S&P 500. It's just like, that is just the worst way to think about it. And they're making decisions based on their cognitive biases. So yeah, as I said, like the platforms available these days allow us to take cognitive biases out and just invest, I guess, more back to the theory of it, which is consistently over a long period of time and let compounding do its work. Like, that is a proven method that will result in you being very well off 40 years.
Which, interestingly, there's a real parallel with the way that I certainly approach property investing, right? So you approach property investing by choosing a really good asset. So in your case, you're choosing really great funds to invest in, or, and then you're committing to investing in those funds over the long term. And that's the equivalent of paying off your mortgage, if you like, and contributing to, to building up your equity in that stake or in that asset that you've chosen. And then letting it do its job and not then getting, rocked by, what's happening in the marketplace. You made a good decision in the first place. You commit to that for the long haul and you keep committing to that. And, back to a bit, the question I asked you about earlier about, does it worry you about, just the amount of bad advice out there? With the stock market, with shares, I guess you can work out a lot quicker with a lot less exposure and a lot less of that commitment, if you like, that you've been going down the wrong path. So in a way, you could sort of follow some charlatans and potentially mitigate your losses, as opposed to property, where the consequences for getting it wrong are catastrophic, and for many people will never get back in the market. So I guess it'd be interesting to know, I mean, those Friday Instagrams, which I absolutely must follow because I just, I don't, but I will. Do you get people coming to you, to your audience, converts to your audience, and they sort of tell you these stories? And I guess what would be the average, what's the damage for people sort of going down the what's seen as the easy route, but it's actually the wrong route? You know what I mean? So what would you say was the exposure of people?
Yeah, I mean, look, I think everyone has stories of the mistakes they've made and the lessons they've learned along the way. And you can only hope that people learn those mistakes early when they're not investing a heap of money, and then, actually learn from those mistakes and change their behavior. I mean, no one is going to have a worse start to their investing lives than I did. I was at uni, had a subscription to the AFR, thought I knew everything. Saved up $1,000 to invest, which was a lot back in uni days when I was working part-time, and put it all in Slater and Gordon, which was a law firm that was getting a lot of good coverage in the AFR. Fast forward about 12 months, my investment was down 99%. I'd lost so much money that I couldn't even cover the brokerage cost to sell the investment. And so it sat in my ComSec account back then for a long time, just reminding me that, like, you're an idiot and you need to do more work and you don't know everything. And that was an expensive but invaluable lesson. And I think a lot of people start that way. You internalize like certain things about the stock market, that it's a way to get rich quick, that, what we see in the media is a lot of short-term trading, a lot of people analyzing charts, and you think, all right, well, that's what I've got to do. And then hopefully people learn that there are other ways to invest and perhaps more sensible ways to build long-term wealth. But you're right. Like, the great thing about the share market is you're not massively over-leveraged into a bad asset that you then struggle to get out of. So, yeah, the liquidity is definitely a safety net in some ways.
I'm on a personal mission to help more people make better property decisions, and you can find out all about what I'm working on at veronicamorgan.com.au. There you will find resources for first home buyers, details about my buyer's agent mentoring program, information about my newest project, Preferential, proactive property management in Sydney, or if you're looking to buy your dream home or investment property in Sydney's inner west, eastern suburbs or lower North Shore, you can connect with my team at Good Deeds Property Buyers. And if you'd like a 30% discount plus free postage for my book Auction Ready, How to Buy Property at Auction Even Though You're Scared Shitless, and yes, I'm a potty mouth, use the code ELEPHANT at the checkout.
If you're looking to buy your first home, thinking of upgrading to a new home, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and importantly get the finance right. Please reach out to myself and the team at flintgroup.au. I mean, obviously you've got a brand out there and you're going to be a good community for investment funds, right? For the latest active fund, would love to be advertising to your audience, for example. How have you, there's a struggle that I had as an advisor, right? Very early days, I knew what I knew. I didn't know what I didn't know. And all of a sudden I went down different paths as I went to different events and got hit by different marketing pools and went down the whole trading path. So you really got to almost figure it out yourself a little bit. How do you sort of stay true to, what your beliefs are when you've got all this sort of marketing people and all these latest crazy ideas? Do you just still always go back to the fundamentals? And but it's really hard to do it because, funds can perform really well. Let's say it was the crypto craze, or let's say it's high yield, or let's say it's REITs. There's always or infrastructure. There's always this new best thing, or thematic investing, etc.
Bitcoin.
It's how do you sort of not give what your audience wants, because they do want to listen to those things because they are hearing it a lot, but they also need to hear good advice that that can be part of a strategy, but diversified, etc. How do you manage that conflict?
It's a balancing act, no doubt. Like, you are right. We have every financial institution in Australia wants to talk to a large group of cashed up millennials who are early on in their investing journey. So, but I think Ren and I do a good job of of reminding people of the journey that we're going through and how we're doing it, and that this is a journey of continuous learning and development. And there's no point that any investor, I think, gets to a point where they're like, I know everything, I've learned everything. And so our role is really just to be the conduit between the world of finance and everything that is confusing and overwhelming and our audience, and to kind of connect the two in a way that we're not trying to push and force ideas and product on them, but puts them in front of products and ideas and different strategies and lets them make up their mind on what is right for them. Because one of the biggest messages that we say on the show is that there's no right way to make money in the stock market. If you want to be a day trader and do that, you can do that successfully. We don't recommend it, but you can do it. If you want to do options and puts and trade derivatives and whatever, you can do that. But that's not how we do it. So we kind of center it around our journey, but know that we have a role to play in educating everyone on what else is out there.
But yeah, I mean, look, every sponsor we do gets a brand check, and there's some deals that haven't been done just because we don't think they align. But I think on the most part, like the brands that are trying to speak to retail investors, and in particular the brands we work with, like they're generally like pretty well-known and established institutions, like the JP Morgans and the Fidelities of the world, with like long track records and, track records of doing the right things by their investors. So, yeah.
Yeah, it wasn't coming from more the marketing spend. It's more coming from the just the consumer or your community has an interest in this idea, right? And sometimes you could say, I'm not going to talk about it, but you actually do need to talk about it because they really want to talk about it. And it's then re-educating them on, that's not potential. It's kind of got to go back to fundamentals, etc. And if you don't have those conversations, they're going to go and head down different directions because they get caught up in the marketing spin. It's just, the returns are so good versus what they're currently doing. Maybe we just need to jump on that train. Do you find that's a constant challenge for you?
Yeah, I think, again, it's like we just have this view that our audience is smarter than they're given credit for. And I think, to talk to recent booms, like crypto is one, lithium was another one that's come well off. Like, you could take the approach that, like, we're not going to talk about this thing because it might fall in the future. Or you say, look, we can talk about anything, but we need to talk about it in a way that's sensible and rational and contextualizes it in the history of the booms and busts of the stock market. And so we'll talk about crypto, we'll talk about lithium, we'll talk about anything, but we'll be grounded in the principles of, like, long-term investing, core and satellite portfolio construction. I think for us, that's the main thing. Like, I would say as long as the majority of your assets in the stock market are in index tracking funds, and then you want to take a punt on a theme or a stock or a crypto on the side, there's nothing wrong with that. You just have to be really go in eyes wide open about the time horizon of this investment, the risk inherent in this investment, and how closely you have to monitor it, and probably have a stop loss on as well.
Yeah, I mean, it might take us down a different track. Obviously, you guys, we haven't had many of our clients individually. We just interviewed people in the property market, but just coincidentally, you both have purchased properties in the last couple of years, right? And and you worked with myself and our teams, and it was an interesting experience sort of guiding you on that. And what were some of your, if you think about, go back to your, pre-coming into it, your property beliefs and your property beliefs after it? Like, did you completely flip from property bears to property bulls? Did you think that, what are some of the things, because it's interesting because, like, a lot of those things hold people back, right? And I think it's once you've got educated on that journey, you probably would say, okay, you can do property, but these are the fundamentals you need to sort of go by. Like, yeah.
I distinctly remember how much I enjoyed talking about interest rate rises before I was in property. Now that I'm in property, when that comes up on the show, I have a bit of a different lens.
Yeah.
No, I think, I don't know. I think I didn't really have too many beliefs. I think I knew it was something that it was a goal of ours and my wife, but it wasn't something that I don't think I had too many, like, preconceived ideas of what to expect. And I think I learned a lot going through the process. I learned what makes a good property, what to be looking for. I learned a lot about the structure of loans and how you can, like, I think we got more than I thought we would get, because I didn't understand really how you could get mortgage restructuring and really actually in the nitty gritty of that. And it wasn't until I started that process that I, understood a bit more about what you could buy. But I didn't really have too many preconceived ideas, to be honest.
I think we get a bad rap here that we don't like property. It's something that we always have to try and correct. Everyone wants it to be oppositional. It's like, oh, you do a stock market podcast, therefore you must not like property. Or sometimes when people start talking about property, they'll apologize and they'll be like, I know that that's not what you guys talk about here. But that's not the case at all. I think, property, you'd have to be blind not to see what property has done for generations of Australians in terms of building wealth. You'd also have to be blind not to see all the problems inherent in the property market today, and not just affordability, but just like, I don't know, we've got friends that have been looking for over a year, and every inspection they go to is 20% underpriced, and then they're instantly blown out of the water. And I think there's a lot of inefficiencies in the market, you could say, or So I think it was interesting to learn more about it. But similar to Bryce, I didn't come with a lot of preconceived notions about how it would all work.
I was about to say, where did you buy?
I bought in Redfern.
Yeah,
I bought in Maroubra in Sydney.
got it. Okay,
Yeah.
so yeah, you're dealing with Sydney auction areas and prices that have been quoted prior to negotiations commencing. And your friends, are they buying in the same areas?
Yeah, looking at Sydney, and Sydney broadly defined, like everyone starts with an area they want to live, and then as their hopes slowly degrade,
Get shattered. Yeah.
the weekends of inspection,
We're in Wagga Wagga.
the criteria gets smaller and the radius gets bigger. But I think that's an experience that a lot of people have gone through with property.
It might be an interesting one for Veronica. Alec used a buyer's agent.
Mhm.
So, I mean, what was your, because naturally that's a different type of service, and, it's not a cheap service when you talk to, when you're putting a lot of money into housing already. What was your sort of thoughts maybe going into that? Because it's interesting for, people to sort of, consider how, because all the things that naturally people, I deal with it almost every day is fears around using a buyer's agent. Do they really need them, etc. Maybe it'd be interesting just to talk about that and versus your experience.
Yeah, it's something that we hadn't really considered, and you recommended a buyer's agent, Chris, for the area that we were looking at, and I cannot speak highly enough about the experience. It was really positive for us, and we're really happy with where we ended up. And we bought a place off market, and feel like we got a pretty good deal. So I think, the process and the outcome was really positive. And, some of those friends that I was alluding to earlier, I've made the suggestion that they should speak to a buyer's agent. But, it is a lot of money. It's a lot of money that you can't add to your mortgage. It comes out of the money that you have for your deposit. So I understand all the reasons why you wouldn't want to do it. And I think the reason we took you up on it, Chris, partly was because, you recommended it and you were sort of the expert guiding us through it. But it was also just like we both realized how much we didn't know when it came to property. And I think like a big learning for us is sometimes it's worth paying for that expert service, whether it be like financial advice generally or a buyer's agent in particular here. Because we knew how much we didn't know.
Yeah, and I'll sort of caveat what you're talking about, your good experience. I'm really pleased you had that good experience, and I would hazard that one of the reasons you had it was because when Chris recommends a buyer's agent, Chris is very critical about viewing. There's so many new buyer's agents in the market, for argument's sake. Most of the work wouldn't get near Chris, and he vets the people that he would recommend very, very closely. Bryce, you didn't use a buyer's agent. I'm curious what's your journey in that regard? Did you ever sort of think maybe we need a bit of help, or did you sort of in retrospect think, do we always do the right thing? I'm curious.
I had a very different journey to Alec. Alec was a one-hit wonder. One weekend, and he'd bought a place.
I will say too, that's not always the experience of buyer's agents. It's like we don't pull rabbits out of hats.
So we had a much longer journey. I'm going to say 18 months to almost close to 2 years. But I think because we went to Chris early on to see what our borrowing capacity was, figured out then that, it was going to be tied to the business. Harriet, my wife, still had HECS and various bits and pieces. So we kind of closed all of that out to maximize borrowing. Then went back to Chris and said, all right, we're ready to rock and roll. But then we had a 12-month period. So we didn't go down the buyer's agent path because I hadn't had anyone with an experience like Alec where it was like, this is, that glowing review. And we were kind of keen to try and get out there and see what was available. So we did about 8 months of solid looking, then got really worn down, went overseas, had a bit of a break. In that 8 months, I kept all of the flyers that you get when you go to the CC, the property place. And I think we had seen about 48 places or something along those lines, 48 or 50 places. And then through that process with a list that we'd kind of developed with Chris, we really got an understanding of, okay, what is achievable? What are the things that we're really willing to concede on when we're buying a place? What makes a good asset? And kind of started forming our own opinion on what value was, because when we started, we had no idea on what like good value was. And even though, maybe what we bought was not good value. At least we still thought it was, because we'd sort of formed our opinion on, this is better than what we saw last weekend and whatnot. Then when we came back from overseas, we were kind of like, that was a bit dejecting and whatnot. And I remember calling Chris being like, we want some buyer's agents. He gave us a list. And then that weekend we went out and it was just right place, right time. We'd known these agents now for such a long time that they were pseudo acting as our buyer's agents in a way, because they were really trying to help us find a place. And he just said, mate, there's a house around the corner that you should go and look at. It wasn't on our list for that weekend, but we went and checked it out and kind of everything fell into place. The agent who was listing it was out of area, so she really didn't have an understanding of the value in the area.
Yeah.
It was meant to go to auction. She then got someone put in an offer before auction, so the auction was pulled. It then turns out this guy couldn't get financing, so then she looked a bit silly in front of the owners because there was no auction and this guy had pulled out. It was a place that the kids had inherited, and so they put it through a renovation, but unfortunately had to put it on their mortgage to pay for the renovation, so they then wanted just to get it off the books. And so it all happened in about 48 hours, and I think eventually we got to a price that we thought was good, given what we'd seen over the past sort of 8 months or so. So yeah, a bit of a different journey.
Yeah.
But we kind of felt confident. And of course, we were working with Chris pretty closely on sending him, I think we almost sent him 50 links for every place.
Chris was probably sick of you. He just wanted you off.
No, I mean, the interesting thing there, though, is if you look at the 48 places, you look at the first ones you looked at and what you bought, like they're chalk and cheese in terms, and that's one of the things I would say with engaging a buyer's agent is, do a bit of figuring out what you really want first. I do find that, if you go to a buyer's agent too early in your journey, you don't have to take that period, but just start to really think it, because, buyer's agents do have a habit of directing you in different, ways based on what you tell them, right? And if you haven't really thought it through, what you really want long-term, what's really going to be the right fit for you, sometimes buyer's agents can be a little bit trigger happy. Do you agree, Veronica? Like in terms of you go in and say, I really want an apartment. Okay, I can do that for you. Great buyer's agents don't, but there is naturally about trying to make a deal happen. And so I think where you were originally looking, that property versus what you ended up were different because you went through a journey and you sort of educated yourself. Do you agree that on?
Oh, absolutely. We laid them all out on the table at the end and said, "Can you what? What
was the first property?"
Oh, the first one was the one that we were talking about on Equity Mates the other day. That like pseudo commercial zone, and then going through the experience of apartments. I think it was like we were stuck on an area to start with. We were like, this is the area we want. And as you were saying, Ren, you kind of then say the area and then do we really actually want to live in these apartments in this area? Like, is it and kind of went through that process of it's not so much the area, it's actually what we want to live in. And then, we're not going to get any, long-term here. Do we want to be trading in and out of this? And all of that conversation that takes a lot of thinking, a lot of, planning, I guess. Yeah.
Discovery. I mean, look, a really great buyer's agent will take you through that process in their onboarding, but unfortunately most aren't that great. And the fact is, I've run a buyer's agent mentoring program and really teaching skills to new buyer's agents. In fact, some of our members have got 10 years experience. So it's not only new, we're constantly learning, right? But, I draw a distinction between an order taker and a trusted advisor. And the order taker is the person who goes, oh, you want one of them? Sure, I'll go and find you one of them. And there's no critical thinking. There's no advice given. It's just it's fixing a pain point right here, right now, without really looking back, stepping back and thinking, is me solving that little pain point right now, is that really, really good for the long term or even the medium term? So, that's interesting. But what you've done is take it, and that's the equivalent. Like when we onboard clients, we do what we call a getting started session, which is basically doing all the research to truncate what you did over an 18-month period. We do it in a 2-hour session for our clients. But it is important to make good decisions. You've either got to find an advisor who is able to bring that lens to it, or you go out there and do the work yourself. And I've got a program for first home buyers, a course that we teach the entire process, and you've gone through our sort of the where to buy process that we talk about, which is really working out what's important. What's your budget? It's the 3 Ps: your price, the product or the property itself, what's in it, and the position, the location. And there's all these little levers you got to pull, and everyone's outcome is different.
Yeah.
So you got there. Well, it's great that you got there in the end. It sounds like the stars lined up at the end, at that moment.
Yeah.
So I got a question for you guys as the property experts. One thing that kind of struck me, because it seems like there's so many buyer's agents now, and it struck me that we might be getting to a world where there's like a grey market before anything lists, where, like multiple buyer's agents are sort of played off against each other, given the inspection. And then it's only if a real estate agent can't get a buyer's agent and the price they want, then they'll put the stock on REA Main and go public. And it kind of feels like then, if that's the case, then to access the best stock, you've got to pay, X amount to a buyer's agent to get it before it goes wide. Is that, you guys are both shaking your heads, so you don't agree?
That's a perception that is put out there by buyer's agents who I will call them property traders rather than buyer's agents, right? They're looking for deal flow, and they're also tapping into the process. I mean, look, and this will vary according to the type of buyer's agent, where they're buying,
location,
whether they're local specialists or whether they're buying, far-flung areas. But even a local specialist, right, when we get access to off-market properties, right? So the agent is going, what they're often doing in a stock staff market, the sales agent is going to the potential vendor and they're saying, look, potential vendor, look, no risk. Why don't you just list it with me for a week? I'm going to bring people through from my database and if we get a really great offer, then you can sell it, right? Now, some agents do parcel out really shit properties and bundle that off to buyers agents that they know lack discernment, but pitch this idea of the grey market, the off market, the secret market. And they've got clients only too willing to pay through the nose for this crap because they in their perception, they're getting something exclusive, And so there is that market. It's not a good market to be playing in, and the good stuff, every sales agent wants to take that to market. Every sales agent wants to advertise the good stuff. They know that they're going to get listings out of that good stuff. They know that they're going to get profile out of that good stuff. They know they're going to get more buyers than can possibly buy that good stuff, because really good properties will attract more than one buyer. You know what I mean? So they're going to build their database through that. The secret hidden market really doesn't suit real estate agents, right, if it's good stock. What they will do, though, in a stock-starved market, because listings have been down for some time, it's part of their sales pitch to go in there and say, right, we're going to show this, this hidden, the database, the property. Now, if they don't get offers in a sort of vein that makes it enticing enough for the owner to sell, that owner is then they're in the vortex, right? So they're on the slippery slope. They've already done that much work to get the property ready for a private showing. It's only a small step to take it from there to, well, why don't we actually look at doing a campaign now? We had really good interest. It wasn't quite at the level. If we actually do a campaign now, we can build interest. And so, it sort of marries up. You've got the buyer's agent that's selling this false dream of the hidden market, and you've got the sales agent trying to entice the owner to actually get into the process of listing their property for sale. So you can see how these two levels of self-interest, if you like, coincide to make a perfect storm, and the buyer themselves isn't really best serviced through this whole association.
Oh, it's funny you said this story around the sort of the sales tactic, and let's just test the market. A good mate of mine, just last week, this happened to him. The agent sort of was knocking on his door. He's just done a reno, and he's done such an amazing job, and he has, like, in fairness, and there's a lack of renovated places on the market right now. How about I just show it through some people and see if I can get some offers? And bang, some offers have come in, obviously, because there's a stock shortage, right? And actually, he's going, well, if there's that much demand, maybe I should do a campaign. And so it was, and now it's on the market. It was coming on the market, and they're going to sell, and they're going to try and do another reno and lots of stuff. But it's interesting. I think for good properties, though, when the market's hot, and this goes against buyers agents, to be honest, is if that gets on domain, it gets on real estate, more eyeballs,
Yeah.
They run a proper campaign, do the open home, and then, and all the evidence backs that you're going to get a better sale price at auction, for great properties under that pressure cooker, maximum social proof, all the FOMO of the options and things like that. If it's a great property and the campaign's run well. So
now, I tell you what though, in a hot market, everything gets competitive. So a buyer's agent value for money, or value proposition under those circumstances is actually helping the buyer have the discernment over which ones to pay a premium for and which ones not to pay a premium for. So there's a lot of ways, I've never pitched in my business, oh, well, that's how, we'll save your money, time, and I'll get you all the off markets. Those things are wrapped up in it, but they're not the main value proposition, right? Good advice is the main value proposition. And if you're after a property that's hot and heat spies are going to be on it, well, then you have to have a really good strategy and understand how to really price that property, how to set your limits for that property to try to buy it prior if you can, and how do you do that? Or if you're going to have to go to auction, you've got no choice, how do you bid and how do you actually give yourself the best opportunity of owning that property? So there's a lot more that a really good buyer's agent will bring to the table under those circumstances, not as simple as avoiding competition. And I think that this is a misnomer. I mean, a lot of people think, oh, I don't want to compete for a property. It's like, well, actually I do, because I want a property other people want, because then down the track when you go to sell it, they're going to want it. And if they want it, they'll compete for it. And that's really fundamentally the secret of capital growth.
Yeah. So we've been doing a segment on this podcast called the
Dumbo.
Oh my God, Dumbo.
You forgot.
I've just forgot. Done 380 of them. Very early days, we saw that, like you said, learning from other people's mistakes, right? And just having a bit of a play on this and have a bit of fun with it. Have you guys got a bit of how's that for yourself, right? Because you guys have.
You can always give us your own one.
Yeah, always good. But any property Dumbo stories, or if you can't figure that, we can go to investing. But let's see if we can get a property one in here.
Lesson we can all learn from.
Had to make a huge mistake that Chris saved you from or something. So that was...
Oh no, I mean. Not Dumbo, but maybe, I don't know. I just had, the emotion, we spoke about cognitive biases earlier in the episode, and I think it was no more present in the property search for Harriet and I at particular points where we would get overly emotional about what was in front of us. And I think we got carried away with putting in or thinking about putting in offers on places that we probably knew deep down weren't right, but we tried to make excuses to ourselves as to why it would be the right thing to do. And in hindsight, both of them we sent to Chris, and I remember at one point he just called me and was just like, "You've got to just have a breather here, because what you're about to do is you got to think through these points." And so, yeah, I think emotionally, it was an emotional journey for us, but that in hindsight saved us a lot of money and heartache, and we did get the right asset. But yeah, I think because you're seeing it and you try and you think about what life you're going to live in these places and these sorts of things. So different to buying 1,000 companies on the S&P 500, not really.
Yeah. Very much so.
I don't really, well, I mean, hopefully I don't have a Dumbo property story, because I've bought one place and I'm less than a year into paying off the mortgage. So, yeah.
What about your listener questions over the years, or just, in your events, just so many live events, can you think of any property stories that someone's just come to you and said, oh, I've lost X, Y, Z, or I shouldn't have done that, or this happened? Is there anyone you can think of by the top of your head? Put you guys on the spot, but.
Yeah, I mean, nothing for property comes to mind. Seems like everyone who can get into property does well. That's the bloody frustration of this market.
Well, I would be.
That's probably the Dumbo, because it's not true.
Yeah, that's right.
I've got one that I think was surprising, I guess, and it just really highlighted to me that you can buy bad assets, and so early days of grad program. When we left university, one of my grad mates bought a studio apartment bang in the middle of Darlinghurst. We were actually living on the street, Darlinghurst Road, up near the Coca-Cola sign, middle of city, King's Cross, with the belief and the understanding told by the real estate, blue chip area, can't go wrong. I think it was like 32 or 42 square meters or whatever it was. And that was in 2000 and I'm going to say 17 or 18. went to sell it last year. So there's been a boom and a little bit of a bust, but mainly boom. So couldn't sell it for less than 100. Took $150K haircut on it. Right. Yeah. And he couldn't believe it because he was just like, I was told and had the belief that this is it's the middle of Sydney. It's CBD, it's Airbnb, it's like, and I guess he just bought wrong. And for him, it was just mind blowing that the perception of you can't go wrong with property if you buy in a good area, and probably just bought the wrong place in a good area. It was just mind blowing. And it was a good reminder for me that, what you've said plenty of times, Chris, it's just like, regardless, you just got to try and buy a good asset because people do go wrong.
You've just hit the nail on the head in terms of what's wrong with a lot of property advisors, where they're really so focused on the data and so focused on the location. And if you don't know how to choose a good asset in that location, you can lose money, as you've just given that example. And even that's even worse example because, yes, the actual median price in Sydney has gone up between now and then, but also $150,000 on a studio apartment, that's a big percentage. So it's not even a small loss. That's actually quite a big loss. So that's a great Dumbo, and I'm very sad for your mate. Hopefully he's recovered since.
That's one of the reasons we do the segment, to be honest, is, it's one of those at the barbecue. People are probably happy to talk. I lost some money on some shares, because it wasn't that much. But when these property decisions and they're compounded, they're much bigger. That's life changing for that person. When it goes well, when it goes bad, because to save $150,000 after tax is a lot of money, let alone all the selling costs. And they're compounding what that would have been over the next 30 years, that person, and all the decisions they can't make in the future because they got that first one wrong, and hence why we're so passionate about it. So good for you guys to come on. Wish you lots of future success and keep increasing the financial literacy of the country. So thanks so much for coming on, guys.
Thanks for having us.
Yeah, thanks, guys. Really appreciate it.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.